think the inflation is not a problem anymore. It's settled down. But monetary policy is very helpful. It's become accommodative. We've seen European Central Bank had 8 rate cuts. The Federal Reserve has started cutting rates again. That's helpful for the general economic cycle and for liquidity in the market. The general economic cycle is good for Europe because we are only 50% domestic oriented as a set of economies and 50% export oriented. So as the global economy trends up, that's really helpful for Europe. And then the last point was in regards to the growth. So Europe hasn't grown as an economy in years, but there are some structural reforms going on that should help underpin that cyclical momentum we are about to pick up. The good news is not many people are invested in Europe. So we've had at the beginning of this year a big spike in interest, but it was very brief and momentum very quickly faded again. And so in my view, my perception, speaking with investors from all over the world, not many are positioned for another European bull market. So in my view, valuations record low versus the US. But investor sentiment, investor positioning, it seems we're also right back at the lows. So our outlook is very positive for European stock markets. And, I think the reasons that will drive this positive return over the next 12, 18 months is going to be the cyclical momentum uptick in the general sort of economic growth in the world, the regions we're exporting to. B, there's a number of structural reforms going on that should lift Europe's growth potential as such. So predominantly we have those in Germany, undoubtedly the front runner in Europe. And in Germany, the new government has promised an autumn of reform, they call it. And the aim, so I've just been in Berlin a few weeks ago, meeting a number of the ministers and the secretaries of state and so on. The aim of the new government is to lift the structural growth potential, which at the moment is probably assessed as 0.4, 0.5% a year structural growth potential for the German economy. Their stated aim is to lift the growth back above 1%. And so we have the infrastructure spending package. We'll get soon the announcement for a new Deutschland fund, another 100 billion euros of stimulus of fiscal investment. But then on top, we have the private sector initiative and we have the labor market reforms that are beginning. Now, the big prices of pension reform and so on, that will come probably a year from now, but it should accelerate then in that time the growth. On the European level, we also have a number of positive initiatives going on. So we have securitization market reform. We have a likely reform of the banking core tier 1 equity capital requirements. And then the big prize, probably about 2 years from now, the Capital Markets and Savings Union. But just to highlight the potential, the securitization reform, for instance, that is important because 70% of all European funding needs come from bank loans. And so securitization market is sort of the recycling for the capital that the banks are expected to lend out again on the front end. But yet we've made securitizations ever harder. We shrunk the secondary market since the financial crisis. And now the reforms underway should expand that market again. And so inject capital again into the European economy. Capital is already here. Capital that is held back by regulation, that can be unleashed with the stroke of a pen from a regulator, and thus would not require any new debt raisings or so, and would not require any interest payments. It would just recycle capital that's in the economy but unproductive at a faster pace back into the GDP. For us, it's always about the rate of change. So we always look for stocks that exhibit a positive, underappreciated rate of change. So we are style agnostic. We are not growth investors or value investors. We want to play both sides, and both sides have their market phases where they get rewarded. But we want to pick agnostically. We want to be able to pick from both sides. And it's always about that rate of change, therefore. And I think one of the key things we're looking for, we are assessing, is always who are we investing in? Who are the CEOs, the CFOs, the other side of the table? Who are we entrusting our clients' money to? Are these good stewards of capital? Can we trust them? Do they have a proven track record? And then one other thing is we increasingly engaging with the non-executives of these companies. So it's this, who are we investing with? So who sets the targets for the CEO, the CFO? Why do they set them that way? How do they incentivize the CEO, the CFO to achieve these targets? Does their vision align with our vision? Do we think it's a money-making vision for our investors of how they see the company progressing over the next 3 to 5 years? So for us, these are the key things. Rate of change, who are we investing in, who are we investing with? So the most attractive areas for us right now are certainly still defense, unfortunately. But look, the delta between the capabilities Europe needs and the capabilities Europe has is just vast. So for instance, the old NATO standard before this year's NATO summit, the new standard is not disclosed, so we don't know, can only speculate. But the old NATO standard said, for instance, all member states should have at least 30 days worth of combat ammunition inventory in artillery ammunition. 30 days worth. At the moment, we have less than 1 day. So after 1 day of combat, we would have to throw stones. That gap, just from looking at the production capacity that we have across the entire West, that gap would take about a decade to fill. And yet we are only pricing 3 to 4 years of extraordinary growth in defense stocks. And there's many more examples across all areas of defense, main battle tanks, air defenses, long-range weapons, and so on and so forth. But defense is definitely one of our key picks at the moment. We also still see good potential in European banks. Now they have run very, very hard as well, probably consolidating a little bit at the moment. But ultimately, if you take a step back, the balance sheets have been fully healed. We are achieving great returns on equity. In our view, these are sustainable. We are achieving these returns despite 8 rate cuts of the European Central Bank. We have a positively shaped yield curve. We had a deleveraging in the private part of the economy, not the governments, but the households and corporates have delevered massively over the last 15 years in Europe. So there is no bad loan cycle. And ultimately, these stocks are not priced for that still, despite the rally. They're still trading at about 1 standard deviation discount to their own history in valuation terms. So defense, financials, and thirdly, I want to single out probably semiconductor stocks, in particular our enablers of the AI revolution. So we have some semiconductor equipment companies make the machinery to enable the production of these chips. They're just unique in the world, that have an irreplaceable standing. And these stocks had been going through a down cycle for the last 2 years. And we've recently changed our stance and picked some of these up again. And then the last area probably to highlight on the plus side, on the positive side, would be, and it's maybe related to the AI theme, but the general electrification. We had a revolution on how we produce energy. So we had the green revolution. We switched off coal-fired power plants, gas-fired, nuclear, replaced it with wind and solar, which made the grid less stable, the energy production less predictable. On the other side, we have a power demand inflection. So after 20 years of ever steadily declining power demand in Europe, a power demand is suddenly picking up because of data centers, because of AI. And it's met in the middle with a power grid that can't cope. And we built this power grid in the 60s, 70s, 80s. A lot of this equipment is at the end of its physically usable life. And now it's the bottleneck in the middle between rising power demand and then less predictable, less stable power supply. And it needs investing. So those are the good areas. Then we have some in between where something positive could happen, but we're not so sure yet. One area, for instance, is telecommunication. Horrible sector for decades, horrible. Guaranteed to lose money. But what is changing is the M&A. So we have more than 45 major telecom operators in Europe. In the US we have 3. China we have 3. India we have 3. Why does Europe need 45? Doesn't make sense. And so we have a new competition commissioner, and we have a new head of the bureaucracy, like the bureaucratic number 1 to the competition commissioner. And essentially the message has been from the competition commission to the sector, come and test us. See what deals we might permit. And so the sector consolidation, once it kicks off, and there's signs that it is underway now, could be very good for the sector. And then areas that we don't like, areas that we're struggling with, consumer staples. Share price action is quite dreadful, multi-decade lows relative to the market. Now we have individual stock-specific picks, companies that have undergone their own restructuring, where we see a positive rate of change that I mentioned earlier, and who we're investing in is very good. But the bulk of the sector is just not working. The same, unfortunately, in many of the pharma and healthcare stocks in Europe. There's a real divergence. There's 2, 3 very good stocks, and then a big bulk of the sector that's just not working. And for us, we don't see how these things would inflect quickly. I think they have a place. I think they have a place, and it's not about making Europe great again, but it's about making Europe better again. And it's a stock market that is not priced for better. And if I go back to what we said initially, we always look at that rate of change and what is priced in. And I said at the beginning, the valuation of the European market versus the wider world market, and in particular the US, is at an all-time low. The investor positioning sentiment seems to me to be very low, maybe all-time low. And yet we have these positive cyclical effects right in front of us, and we have the policy effects, the reforms right in front of us. So the market is not priced for these. The market is not priced for this positive rate of change. And it's not a very liquid market. I mean, it's only about a 4.5 trillion or so market capitalization. It's less than Nvidia. So there might just be a time when it becomes clearer, when these things come into clear view, that a lot of money runs through that same door at the same time. And then we get a very quick boost. And let's not forget what happened at the beginning of the year. These things can unfold as a matter of weeks and months. And coming from record low starting points, it seems to me the risk reward is very good. Spain's been one of the highlights, very clearly. I mean, it's one of the fastest growing, if not the fastest growing major European economy. I think the stock market is at 5, 6, 7 year relative highs versus the wider European market. Look, there's many individual stories in the stock market in Spain that are very attractive. So I mentioned just now in the preceding question the utilities. Iberdrola, probably the best utility company in Europe, especially exposed to these trends. You have in Spain, there are a lot of US-oriented infrastructure companies. Now, obviously, we know about the strength of the US economy, the structural reforms going on there, and so on. So it's very good. Banks are mentioned, a number of excellent banks, no further than the top 2, top 3 banks in Spain. So yeah, a lot of things that are attractive to us. Yeah, I think now is a good time. I think, seriously, I think the seasonally, right, the last day of the third quarter, I think we have a strong setup for the fourth quarter, typical Christmas rally, which tends to be especially strong and with particularly high hit rate in years where the index is already up, which it clearly is in Europe and in Spain. The second aspect is then the cyclical improvement that I foresee, sort of world GDP growth picking up again, driven by our big export markets. And then lastly, the economic growth in Europe that I think ultimately will improve from the structural reforms that are going on. And yes, some of these reforms, they might not be as far-reaching as one could have hoped. They might not be going as far as Mario Draghi in his report a year ago had pushed for. But still, they're a step in the right direction. As I said, it's not about making Europe great again, the best, no, but it's about making Europe better again, for which the stock market is not priced.